Good morning to every one of you. Today's topic is origin and definition of accounting. This is the first video related to the subject accountancy volume 1, otherwise known as financial accounting. Now let us see the meaning of, let us see the origin of accounting. Accounting starts from the existence of human being as in a group, and the group has to manage the finance, record the receipt and payment, and in the group later on become a monarch, and the monarch thought of expanding it by conquering different states, thereby their kingdom became very large, and for running that they need finance, running the government finance. For that they collect tax from people and spend for the welfare of the society and for military activities, and also maintaining the monarch. Thereby, in order to record that taxes collected and that expenses incurred, so that crude form of recording started in very olden days. That means even 2000, before 2000 BC itself. But the accounting as a systematic one, recording, started in the year 1694 through the publication of the book The Double Entry System, Principles of Double Entry System, written by Luca Paciello of Italy. After that, we are following that double entry system, and there is no change in the system so far. That system itself is being adopted. And when we are referring about the definitions of accounting, there are two important definitions are given. Let me read the definitions. First one is given by the American Accounting Association. It defines accounting as a process of identifying, measuring, and communicating economic information to permit informed judgments and decision by the users of the information. Then second definition is given by the American Institute of Certified Public Accountants. It defines accounting as the art of recording, classifying, summarizing in a significant manner and in terms of money transactions and events which are in part at least of a financial character and interpreting the results thereof. According to the definitions of accounting, that functions of accounting can be generated. There are 4 different functions of accounting according to the definition. First one is recording the transactions. Second one is classifying the transaction. Third one is summarizing the transactions. Fourth one is interpretation of the transactions. That is recording, classifying, summarizing, interpretation. So recording the transaction means all transactions should be written in the book. That book is called the journal. That is book of prime entry or primary book. So in a commission, there may be so many transactions. There may be 10,000 transactions, 20,000 transactions per day itself. And all these transactions should be recorded. And these transactions normally are associated directly with the finance or indirectly with the finance. Monetary transaction we are calling it as. So other transaction we are not going to record. A manager is going to meet a person, meet somebody else, or any other guest is coming. This nature of work should not be recorded because it is not associated with money. For example, selling of goods sold means that would be recorded. Here that is associated with cash. Or goods sold for credit to X means X may be paying cash indirectly associated with money. So that would be recorded in the book per day transaction. Each day that would be recorded in the journal. Then second one is that classifying the transaction. Classification of the transaction means this transaction should be classified into different accounts. That normally real account, personal account, and nominal account. So all accounts put together may be 100 accounts, whereas transaction per day may be 10,000, 5,000, or even lakh. But accounts may be 100 or less than 100. Or sometimes it may be 200 accounts. In the case of credit sales and credit purchase only, numerous accounts may be there. There are some methods of recording for the particular item. Then we are taking, then that is that summarizing the transaction. Summarizing the transaction means all the accounts written in the ledger, that is that in the second one we have seen about that classification of the transaction. Transactions are classified and written in the ledger. Ledger is called the secondary book, and it is a collection of the all accounts. And in the summarization process, all the accounts should be closed and the balances should be drawn. And these balances should be taken to a balance that is called a trial balance. As I told, altogether there will be maybe 100, maximum 100 ledger accounts may be there. That should be closed, and that is got in the trial balance, and some accounts are showing debit balance and some are showing the credit balance. And finally, all the total of the credit item should be taken and debit item should be taken, and it should be equal. Because in the journal we are writing the dividing the transaction into two aspects. One aspect is debit and another aspect is credit. One aspect is in one account. One account is debited and another account is credited. Thereby, that is the trial balance will definitely get a correct total of debit and credit. Then interpretation is the fourth one. Interpretation means that interpret the nature of the transactions by preparing the final accounts. Final accounts are called trading and profit and loss account and balance sheet. And trading and profit and loss account shows the profit or loss, and that balance sheet is showing the financial position, status of the company, what is asset position and liability position. Thereby, these two accounts are prepared through these transactions. Okay, thank you.